Welcome to The Explainer. Today, we're going to distill the powerful, time-tested wisdom from Benjamin Graham's masterpiece, The Intelligent Investor. This is the book that basically turned investing from pure guesswork into a real science.
All right, let's just dive right in with a core warning from Graham that really sets the tone for his entire philosophy. He's basically telling us right from the get-go, successful investing isn't about hype or excitement. It's about discipline. So first up, let's talk about the big problem Graham saw so clearly. And honestly, it's a problem that's only gotten way, way worse in our time. That constant temptation to treat investing like it's just a game of chance.
So, what was Graham's big warning? It was this. Don't confuse real investing with that chaotic, short-term frenzy you see everywhere. It's like he saw a world just drowning in data, but totally starved for actual wisdom.
Think about it. During those big market bubbles, like the dot-com craze, patience just goes right out the window, doesn't it? And people start treating the stock market less like they're buying a piece of a business and more like they're at a high-stakes casino table just jumping from one hot stock to the next. And wow, this chart really nails the cost of all that frenzy. The research in the book confirms a really simple truth. The more you trade, the more you make your broker rich, usually at your own expense. Turns out, patience really is a profitable virtue. Okay, so if the crowd is often running in the wrong direction, who's going to be our guide through all this chaos? Well, let's meet the guy who literally wrote the map. So let's talk about our guide, Benjamin Graham. You have to understand, before Graham came along, Wall Street was pretty much all superstition and guesswork. He's the one who came in and turned it into a real profession, grounded in cold, hard logic and deep analysis. And his career? It was absolutely incredible. It took him from the very bottom of Wall Street all the way to running one of its most successful firms. He not only survived the great crash of 1929, he actually thrived after it. And his track record? Phew, just look at this number. From 1936 all the way to 1956, his fund averaged a 14.7% annual return. That smoked the market's 12.2%. And this was a legendary performance built on discipline, not just rolling the dice. Okay, now let's get to what is maybe Graham's most important idea. It's a fundamental distinction that honestly changes everything about how you should look at the market. So he gave us this crystal clear definition. It's a really simple test, but it's so powerful. If what you're doing isn't based on deep analysis and a real promise of safety, well, then it's not investing. It's just gambling. So this really all boils down to a huge difference in mindset. An investor analyzes and buys a piece of a business. A speculator just bets on which way a stock price is going to wiggle. So Graham forces us to ask ourselves a really crucial question. Are you an owner who's focused on the long-term value of a business, or are you just a trader reacting to all the noise? But Graham's most profound insight? It has nothing to do with balance sheets or market trends. Nope, it's all about the person you see in the mirror every morning. What he argued was that the biggest risks we face, they don't come from picking bad stocks. They come from making bad decisions. It's our own psychology, right? Our emotions. That's the greatest threat to our financial success. And here they are, the most common psychological traps that he saw people fall into over and over again. Things like following the herd, getting way too excited, or panicking when things go down. These are basic human instincts. And recognizing that you have these impulses, that's the first and most important step to actually overcoming them. So, how do we fight back against these emotions? Well, to help us out, Graham came up with this brilliant, super simple mental tool that has helped investors for decades. Here's what he wants you to do. He wants you to imagine that the entire stock market is just one person, a single, kind of bipolar business partner. And this guy, let's call him Mr. Market, you're in business with him forever. You see, some days, Mr. Market is totally euphoric. He's convinced the future is amazing and he'll offer you crazy high prices for your shares. But then, on other days, he is absolutely terrified. He thinks the world is ending and he'll offer you these incredible bargain basement deals. So what's the secret? Graham says the key is that you are totally 100% free to just ignore him. His mood swings? That's his problem, not yours. You can choose to take him up on his crazy offers when he's happy or take advantage of his terrified sales when he's depressed. You see, his volatility stops being a threat and it becomes your greatest opportunity.
And that idea leads us perfectly into the final cornerstone concept of the whole book. This is the big one. It's the principle that protects an intelligent investor from, well, pretty much all of life's inevitable curveballs and our own mistakes. But first, why is this protection so critical? Well, look at this number. If you lose 95% of your money, which a lot of speculators did back in the dot-com bust, you need a mind-boggling 1,900% gain just to get back to even. So yeah, avoiding those big losses is absolutely everything.
And that's where Graham's central concept comes in, the margin of safety. The idea is simple. Never, ever pay full price. Always buy a piece of a business for way less than you think it's actually worth. That buffer, that discount, that's what's there to absorb bad luck, bad timing, or just the fact that, hey, you might have made a mistake in your analysis.
You know, Graham's most famous student, Warren Buffett, he explained it perfectly with this awesome analogy. The point is, you don't build a bridge for the best case scenario. You build it with a massive cushion to withstand any unexpected stress. And that is your margin of safety.
So, what's the big takeaway from all this? Whether the market is flying high or crashing down, you just have to remember this simple phrase, and this too shall pass away. If you focus on your own temperament, treat Mr. Market as your servant, and always, always demand a margin of safety, you can build a portfolio that can weather literally any storm. And you can have that quiet confidence knowing that in the long, long run, this kind of timeless wisdom, it always wins.